Well, hello again, friends. Welcome to the final part of our Planning Personal Finances. And we want to take a brief look at financial services and why they're so important to our financial plan. You know, you just can't keep all your money in your wallet or in your home, even if you have a lockbox and a safe. Now, I do think it's important to have some money at home, but we need to establish relationships with financial services, and that's going to be banks, credit unions, life insurance companies, investment companies throughout our personal and professional lives. So let's take a quick look at here as we wrap up our unit of financial services and how much these have evolved in the past 20 years, certainly since the year 2000. Decades ago, we would stand in line or have our car in line for on Friday evenings to basically cash those paychecks, and or deposit them. And now we can do so much online, either depositing just a check, endorsing it through your smartphone, obviously through your banking apps, through direct deposit, to doing all of your finances online. And so lots of interesting things in financial services in the this past millennia, past 2 decades. You know, we manage our daily money needs from purchasing, from our rent to our mortgage payments to buying the things we like to buy, again, from depositing our money. A lot of great things have happened in these past 20 years. And it really helps when you do have the financial services you need, because we can't just go around with cash in our pocket all the time paying for the things that we want. I think you're seeing in the marketplace today that many retail stores, especially smaller ones, are actually not accepting cash, which I find very interesting. They are just a electronic transfer of payments, either your credit card, debit card, or even a banking application that they'll take, but they don't take cash anymore. So, some of the mistakes frequently made in our money, and again, I think it's not having the right type of relationships with financial services, but when we manage the things that we do, we either overspent from an impulse buying and using too much credit. Now, the next unit we go into will be called the culture of debt. And so we're going to really look at how we can utilize credit because we need it, and how we don't go into debt, and how we can actually plan so we don't overspend so much. Because when we overspend, then you don't have enough liquid assets to pay your current bills. And when you don't have that, then you usually have to use your savings, all right, to cover those expenses, or borrow for current living expenses. And as we've said from the beginning of this course, 70% of Americans are basically utilizing 120% of their take-home pay each month to pay for their expenses. And the only way you do that is borrowing. And so if we overspend and we don't have the assets and we start borrowing, we also pretty much have nothing to put into the future for interest saving accounts or investment accounts and retirement that we really need to do. And again, this ties into our financial services, always understanding, where our current finances are. Basic types of financial services that you're going to come in contact with: savings. All right, you need a savings account. You need either CD, certificate of deposit, or a money market fund. We need a demand deposit account. Boy, these are old words that basically mean a debit account, debit checking. Checking is just a debit account. Okay, it's things that we pay from. We'll also probably need to borrow some money, obviously. If we're going to purchase a car, purchase a home, purchase some large expenses, it's always nice to be able to borrow at a very good interest rate. And of course, as your financial plan moves through the years, you're going to get into investments, and you need some insurance and real estate and tax assistance with your financial planning. So these are all the type of services that we're going to look at. Commercial banks and credit unions. These are the two most common type of institutions that we manage our finances on a daily, weekly, monthly, yearly basis. The full range of services from your debit accounts, lending and other services, credit unions. Commercial banks are for-profit. Credit unions are usually non-profit. They're cooperative financial institutions. You're a shareholder if you're a member of a credit union. And since they are non-profits, sometimes they give you a better rate of return on your savings account and a lower interest rate on your borrowing. Again, why financial services? We need to start those relationships with that bank or credit union. Now's a great time to do that. If you are a non-traditional student, you've worked for quite a while and you're coming back to class, you probably have this already. Probably you should have. Again, good relationships with banks or credit unions. And if you are that traditional college student and you're maybe 19, 20, 21, do not wait until you're 25 or 26 to start making your relationships. Or do it right now. And again, under the category of the college student, you can generally get some free bank accounts or very small service charges per month. But always tell them you're a college student. And generally, if you show them your transcript with a B average, you can also get some better deals that way. So start that debit and savings account. Other financial institutions, as I've said earlier, that we will use, we need some life insurance. Okay, we'll talk more about insurance as we close out the class. That's wrapping up your financial plan, but we need security for our loved ones. All right, and look at investments in Unit 3, the money market funds, mutual funds, retirement funds, 401k. So I think you see the picture of how important financial institutions are to our financial plan. Other financial institutional companies that will run into: mortgage companies, credit card companies, other type of financial service providers. Now, many of your major banks and even credit unions can now provide a majority of these services, but mortgage companies, yeah. If you're paying off that home and you want to get the best rate, we'll need to have that relationship. And again, we've had that checking account, that debit account, that savings accounts for a while. When a mortgage company goes to look at your mortgage, that's what they'll find. That's why we have to start this process. Of course, your credit card companies, anything we need a short-term or long-term lending, and there's some very interesting things going on in the online world. We call that financial technologies that make banking quite easy and accessible to all. Well, what about the unbanked population out there and the high cost of financial services, of alternative financial services? And they're out there, my friends, and they're predatory. They are preying upon a target market. And when I say preying, they're not preying for you. They're like this wolf in the picture. They're preying upon you. And they can really nail you with very high interest rates. Pawn shops. Now, pawn shops can be great places to go find some stuff. I don't know if you've ever purchased anything from a pawn shop, but pawn shops do not make their money on buying and selling of the lawnmower or even jewelry. They make it on the loans they make. That's where they make their money. And they're not called interest rates. They're called pawnbrokers' fees. And they're usually ranging to well over 100% on that loan. So be careful in payday loans. These are just rip-offs. Cash advance, post-dated check loans, delayed deposit loans. Basically, on a standard payday loan, if you could even complete it within one cycle, you're charged on average 780% interest. Is that a good deal? Absolutely not. And unfortunately, they know their market very well. And it takes more than one cycle, one payday cycle, to pay that loan back. It takes several. Sometimes it can go into years. And one small $300 loan can turn into $10,000 in a couple of years. So these are the really sad alternatives that so many people in the United States have to turn to. That's why we want to get our financial house in order and literally use the best things that can happen to us in our financial institution. Stay away from these at all costs. And here's a few more. Your check cashing outlets. If you do get paid and you're not on direct deposit, as about 40% of the population in the United States have just a paycheck that gets signed to them on a weekly or bi-weekly basis, and you have to go to a check cashing institution, they may take 20% of the face value of that check. So if you have a $200 check, they're taking 40 bucks out. So now you're left with $160. That's terrible. Yeah, and they do another surcharge upon that. Rent-to-own centers. These are great ways to go broke. You see, avoid these at all costs, my friends, because you want to buy some furniture, you want to buy that computer, that new TV. You're literally buying it 2 to 3 times when you go to a rent-to-own. Now, why are these institutions out there? Because they don't have credit checks, and someone who doesn't have the best credit score, which we will learn about in our next unit, will go to these institutions and they're automatically approved, but it comes at a cost. 300% interest is a huge cost. And of course, your car title loans. Again, tote the note. They'll basically give you a loan against the title of your car, and if I cannot pay that loan back, man, they're taking my car. Please stay away from these at all costs, my friends. As you choose a financial institution, again, you're reading through the chapter, and I believe this is chapter 5, so this is a real good one right in here to look at, how would I choose a financial institution? Again, the services they offer, the fees, the convenience, again, what they have, and you step 1, 2, 3, 4, 5 here and decide, is this where I want to do business? But again, most of your nationally known commercial banks and savings and loans, and always tell them you're a college student, you may get some of the best deals possible right there. Of course, you got large regional banks, and now we have some banks that are strictly online. They're basically using artificial intelligence, and they charge low fees, limited personal contact if you get any at all, but you do have access to your money all the time. So credit union has usually lots of personal services and a little bit higher savings rate. And so that's what you look at in your main provider comparisons in here. This is fintech, financial technologies, and since the dawn of this millennia, we've seen a tremendous growth in this industry. PayPal was eBay's payment system, and then basically turned into a bank because it just utilizes all of the infrastructure that major banks had. And now, of course, they offer a lot of banking services. If you use Apple Pay, Google Wallet, Google Pay, if you Venmo some money, Square Up, Square Cash, there's a lot of entities out there that we can take advantage of, and it's a pretty safe way to do a lot of your online transactions. So financial technology is certainly on the move, and again, all backed through the banking system. If we look at some savings, hey, we need that emergency fund, and your bank accounts are great places to put that in. Whether a regular savings account or a money market account, there's your certificate of deposit. Back in the day, we'll have to go back a little bit of time, in the 1980s and the 1990s, these were actually considered investments. Interest rates were paying for basic savings and money market and CD accounts anywhere from 8 to 12%. Now, if you look at the rule of 72 and let's say you had a 9% interest rate. Well, 72 divided by 9 is 8. Every 8 years, your money was doubling. So if you had 10 grand in a money market account at 9%, in 8 years you had 20,000. All right, 16 years you had 40,000. 24 years, you had $80,000 from that one $10,000 bank account that you had. In 24 years, friends, we've gone through 20 years since 2000. Unfortunately, when the aughts came in, that is 2000, the interest rates went very low, even in the middle to the late 90s. And our accounts now are barely paying 1 to 3%. If you're getting 3%, you're getting a really good deal. So they're just great places now to park your emergency fund. But we still need them. All right, there's your down payment for your home, your down payment for your car, and any other things that you need. So your money market accounts a little more liquid. The CDs, you got a little bit extra interest rate, but you had your money tied up longer for 1 to 3 years, and you really couldn't get into it, but they gave you a better rate. Savings bonds. Again, we'll look at some of this in our investment unit, but I always point this out. If you have grandparents or great grandparents that are still living, or if they've given you an how about inheritance? And you see some U.S. savings bond, and if they're dated back in those 1980s or 1970s, let me tell you something. Do not cash them. You can go to a bank and they'll look at the certificate numbers and they'll tell you the interest rates. And if they're from the 80s or the 70s or very early 90s, those savings bonds may be paying anywhere from 9 to 12%, and they pay that in perpetuity. So as long as you have it, they're paying it. So those $50 savings bonds or $100 savings bonds, if they've been accruing interest, let's say from 1980, even though it says $100, the value may be $6,000 because of the interest it has been accruing for those past 40 years. So hang on to those. You can buy them today. Again, when you buy a savings bond, if it's a $100 bond, you basically buy that for like $50. You buy it at a discount, and it will tell you when it, somewhere in the future, where it will basically is going to mature to that part. Right now, it would be a very long time at 3% or a 1% interest rate. But again, they're very safe. They're all insured, and it's a great place for safety for your money. As you look into any type of an account, there is something called the Truth in Savings Law that basically you want to look at any type of fees on deposits, especially on a certificate of deposit. How long does it last? Is it a year? What happens if you take your money out early? Do you lose just the interest? Do they take out another penalty? All sorts of things we want to keep track of. And again, what's the real yield, and what are any penalties, and what are the conditions of those plans? The big part of your savings account with a financial institution is liquidity and safety. This is very liquid money. You can obviously, for those of us who do a lot of online banking, we can transfer it from our savings to our checking, to our debit, I'm sorry. We can pay bills with it. Again, we are insured to $250,000 per depositor, which is great because back in the Great Depression, if we want to take a history lesson, people who had their money in banks or savings and loans or any type of a home building basic institution that helped other people buy homes, when the Depression hit, there was no insurance whatsoever. And so you had your $10,000, which would have easily been $100,000 today, was gone. There was nothing to back it up. So every time you're in a savings and loans or a credit union, you have your money is basically insured by the Federal Deposit Insurance Corporation. And that's just something nice to have. Now, if you have it in a financial institution like a Merrill Lynch or Fidelity, which we'll talk about, those are non-insured. That's the risk you're taking. Of course, the interest rate you would get in those accounts are much, 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 much higher. That's the risk in return. So again, the bank account, the savings account gives us liquidity, it gives us access, and it gives us a lot of safety. And again, if you have older parents or grandparents and they're at a different time of their lives, they're not trying to accumulate, they're just trying to preserve their income or their wealth, a lot of their money may be tied up into different savings accounts. Well, what if you had $500,000? Easy, you just make two accounts. okay? Or you make accounts at different financial institutions. So that's what I have to do for my mother, and to spread her money around so we can always say that it's insured. Restrictions and fees, again, the big part is how many withdrawals can you make on a given yearly calendar. And so are there fees for that? Yeah, if you are transferring out more money than the bank allows, then they're going to hit you with different fees. And so this is some of the research you're going to do. And of course, checking account, I don't know how many of us have written checks lately. I rarely write a check, and I used to write them. I would go through a couple of boxes of checks in a given year, and I don't think I've gone through a box of checks in the last 5 years, just because I do everything bill pay, like most of us do. But let's just call them debit accounts, and this is where we pay most of our bills from. Again, it's very safe. The debit card is very safe. Most retailers would much rather have debit than a check. Well, of course, your check, they're just taking your numbers from and basically making it, they just give the check right back to you, don't they? But certainly more than cash, okay? Again, these are activity accounts. This is why it's so important to tell your institution that you're a college student, because many times they'll waive the fees wanting to get your long-time business, okay? Yes, there's a minimum balance. We do not, and I repeat, do not want to ever go have insufficient funds on our debit accounts, because then the retailer charges us a $20 to $40 fee on any type of a transaction that did not have the funds to cover the cost. And then the bank also charges us fees. So we have to be very, very, very diligent about always keeping a balance. This is why it's great when we have our checking and our savings accounts linked together. Because, hey, we've all done this. We've all kind of wondered, hey, did I have enough money when I went to the store this weekend? And then you see that it looks like your account hasn't been posted yet, but that debit was more. You can easily make a quick transfer of funds from your savings to your debit, and generally speaking, you can have them linked together for any type of over deposit or over withdrawal fees that it'll automatically cover that from your savings. Again, as you evaluate, look at the fees, look at the charges. Sometimes there's interest rates on a checking account, but 20 years ago, 30 years ago, it meant something. Right now, you'd really want to see what are my fees and charges. And again, you may have no fees as a college student, as long as you generally have a certain amount. Maybe you have $5,000 in your savings account that is linked to your checking. There'll be no checking account fees. These fees can add up, my friends. They can be anywhere from $10 to $20 per month. And you're saying, well, that's not too bad. And maybe it's not. But all of a sudden in a year, that's $240 that's just gone for fees. And so it would make, you're not going to get any interest. So you might as well make sure that your $5,000 savings account always has that balance to, not catch any fees on your other accounts. That's why it's important. There are other payment services. Hey, it's always nice when you do have a bank or credit union that you go to and you have your accounts linked up, and sometimes you may need a certified check. Maybe you're going to buy that boat, that automobile, motorcycle, whatever it is, and you want to get a certified check. If you have your banking services and your accounts, basically it's no charge, or it's a very minimal charge, and again, they'll take it from your account and make it a certified check, or a cashier's check, or a money order. And of course, the transfer services that we have right now. Again, maybe you need to wire money to a friend or a relative overseas, and your financial services can help you with that. If you don't have the services that we've talked about, then you're paying some very expensive fees on all of these items and services right in here. So I hope that this quick unit, why a financial service institution is so important. If you don't have one yet, if you don't have a bank, please let's get that taken care of as soon as possible, because I don't think our personal financial plan runs very well without having it. Again, the great modern comfort of online banking to always know where our accounts is. And for those of us who put it on the phone, I mean, to pay a bill at any given time when it comes in, it's very, very convenient and safe, and it always gives us an up-to-date idea of where our finances full are. And again, when we need to borrow money in the future, when we need to have different services, mortgages, housing, cars, the relationship comes in very, very, very handy, my friends. Develop those positive relationships guides our financial future. Well, that wraps up planning personal finances. So I hope we are on some good, solid ground. I think you can answer questions to your Project 1, Planning Personal Finances. And again, I hope you were able to read through the book, read through my other PowerPoints that I have and notes for you. And I hope you're enjoying this course and we're on some good financial footing. Our next unit will be looking at purchasing and looking at the culture of debt, how to use debt to our advantage, how to use credit to our advantage, how to build a good credit score. I think you're going to enjoy Unit 2.